Now let's get a look at the bigger picture. Darius Dale, founder, CEO of 42 Macro. What were you thinking on Friday? I mean, people started to get a little nervous when they saw selling upon selling. And then you have folks who are saying 20 and 30% sell-off is coming. Others who say, hey, S&P 7,000 by the end of the year. Where do you stand?
Well, thanks again for having me, Nicole. It's always a pleasure to be here. I think investors get way too caught up in the emotions of day-to-day, week-to-week fluctuations. We're going to be in this choppy trading range for a while, but we ultimately think that we're going to break out of it to the upside. We have liquidity accelerating globally right now. It's very likely to begin accelerating on a trend basis from a U.S. liquidity perspective as well, when you factor in the likely TGA spin down that we're going to see over the next few months, as well as the fact that, the Treasury is not in the market tapping us for new debt. Those two things are quite positive. And when you couple the backdrop with global liquidity already accelerating, we should see a, general uptrend in asset markets from a risk asset perspective.
I think there's also optimism on businesses, deal making, M&A activity, IPOs, and that kind of thing. When you talk about liquidity, it seems that a lot of the business folks are feeling a little better about what the potential is for this year. Better corporate tax rate, perhaps, coupled with, I couldn't believe it because I didn't expect him to say it right then, but Jamie Dimon just recently was talking about consumers and that they're sort of back, kind of back, almost going to normal. Really? Good. I like hearing that. What are your thoughts?
Well, a couple things. On the consumer side of things, I would say the consumers has been abnormal for quite some time and in a positive way. We've seen well above trend consumption growth persist for several years now coming out of the pandemic, and that's obviously been supported by fiscal dynamics, but also very strong, historically strong household sector balance sheet dynamics that persist to this day. With respect to the corporate confidence that you cited and this sort of general expectation that we're going to see more business-friendly regulation, increased M&A, that stuff's true, and it's going to, but that's more of a medium to longer term kind of a time horizon. What's happening right now, if you actually look at the data, is we actually having a pretty meaningful slowdown in the growth rate of the U.S. economy that's been driven by historically elevated policy uncertainty, right? If you go and, you look at various indices or measures of policy uncertainty, they're about as high as they've ever been outside of the global financial crisis or the COVID-19 pandemic. So it's very clear we're starting to see a slowdown in growth. Throw a few statistics at you. Even if you just go back to Q4, we saw a contraction, 2% contraction in business investment in Q4 on a quarter-over-quarter SAR basis. If you look at last week's data, we had the New York Fed Services Sector Survey slow to minus 10.5. That was a contraction in the services sector. We saw that echoed by the S&P Global Services Sector PMI. So we're probably going to get a pretty weak ISM services print next week. And that's, kind of all continuing along this path that, hey, as long as we don't have any real clarity of what the legislative process ultimately turns out to be, you're going to have consumers and even businesses in particular, but some consumers kind of put a pause on investment in the economy.
Yeah, and look, there are bits and pieces, as you noted. There are some parts that are stronger than others. Services, PMI services actually saw the contraction, to your point. And we're waiting on the PCE print this Friday, and we'll look to some of the other things like durable goods and GDP. Maybe we'll see some improvements overall. I mean, you think that's potentially for this week, we might get some economic prints that may make us feel a little better?
I doubt it. It's unlikely. So we have growth slowing over the medium term. The pace of slowdown is not something that I think we need to be concerned about as investors, primarily because it's taken some pressure out of the bond market and allowing that valuation headwind to kind of dissipate. But the issue is that if we do see this persistent policy uncertainty persist for quite a while, then you really will start to see a meaningful slowdown in the U.S. economy that starts to feed upon itself. Now, I don't think it's going to feed upon itself in a way that ends in recession, but you could have an uptick in hard landing fears if we don't see a little bit more policy clarity coming out of D.C. But again, I still think that's a secondary risk factor for markets relative to the liquidity dynamics that we highlighted earlier. And in my opinion, those things are likely to net out to a market that ultimately grinds higher over the medium term.
Okay. So you have seen somewhat of a resiliency in the U.S. economy, though. You said, look, it could slow down here. We're waiting on what the Fed may or may not do. I mean, I'd like to still know what your thoughts are on what the Fed and the soft landing or whatever landing you think may go there. And you also have size, sequence, and scope. Where does that fit in?
Yeah, so on the Fed specifically, we expect the Fed to end the Treasury portion of balance sheet runoff pretty soon here, within the next 1 to 2 quarters. The drawdown in the Treasury general account balance that we're going to see as a function of the debt ceiling is going to complicate the process of the Fed ascertaining when we transition from an abundant reserves regime to an ample reserves regime, which was their signal to stop doing quantitative tightening, or rather balance sheet runoff specifically. So it's our opinion that they're probably going to use that lever to remove some of the pressure from the markets in the coming months. And then with respect to our size, sequence, and scope theme, that theme is really just acknowledging that, hey, we're coming into the year after some really robust performance that has caused some very consensus positioning to be built in asset markets. And the sequence, most importantly, of the legislative impact of President Trump's economic agenda may come in a way that is not necessarily great for all that positioning to be sustained. Right. You think about, we're getting the bad stuff first, tariffs and the tightening of the border. That's going to lead to a tightening of the labor market from a wage perspective and ultimately cause more inflation. But then on the back end of that, which will get stick saved towards the end of the year, we got tax cuts, deregulation, the outcome of the DOGE budget cutting process, and all that stuff should be positive for asset markets.
So just quickly for investors, do you have certain sectors that you say definitely yes, be in those, or definitely no, don't be in that sector?
Yeah, so I mean, it's on the sector side. To me, it's more about factors, because the sectors, you pick the right factors, it'll put you right into the proper sectors. We're currently in a risk-on market regime, and generally speaking, you want to be long higher beta cyclicality in a reflation market regime that tends to favor international emerging markets. Those have actually outperformed in recent months, and that's likely to continue.
Gotcha. Darius Dale, great to see you, founder and CEO of 42 Macro. Thank you so much.